the era of financial privacy in crypto is coming to an end. A sweeping global initiative is now forcing crypto exchanges to report user activity to tax authorities, and most people have no idea this is already happening. Today on Web3 Verse, we're breaking down everything you need to know about this new framework, where it came from, which countries are implementing it, and what it means for your privacy. First, let's start with the basics. This new framework is called the Crypto Asset Reporting Framework, or CRF. Think of it as the crypto version of the Common Reporting Standard, CRS, used in traditional banking. If you're not familiar, CRS was designed to combat tax evasion by automatically sharing information about overseas financial accounts between countries. CRF takes that same principle and applies it to cryptocurrency. In practical terms, CRF requires crypto asset service providers, that's centralized exchanges, brokers, and some wallet providers, to report transaction data to tax authorities. Even some DeFi intermediaries could fall under its scope. Fully decentralized, non-custodial platforms generally aren't included, but as soon as a centralized entity is involved in your transactions, your data could be tracked. So what exactly gets reported? CRF mandates that exchanges provide authorities with your identity and tax details, along with summaries of your transactions. This includes crypto-to-crypto trades, crypto-to-fiat swaps, and even transfers of crypto assets. Because this is all tied to your KYC information, your real-world identity is directly connected to your transaction history. This is one of the most controversial aspects of CRF, especially for anyone who came into crypto expecting privacy. Now, who is behind CRF? It's the Organization for Economic Cooperation and Development, or OECD, the same organization that developed the CRS framework. The OECD is made up of 38 of the world's largest economies, and while its official mission is to improve economic and social well-being, critics argue that its broader goal includes increasing global financial surveillance and control. CRF is presented as a way to improve tax transparency, but in reality, it's essentially a global monitoring system for crypto transactions. Currently, 48 jurisdictions have adopted CRF, including major economies like the UK and EU nations. Its design aligns with existing financial rules such as the EU's travel rule and the DAC 8 directive, which also standardize reporting of sender and receiver information. CRF is technically operational from January 1, 2026, meaning platforms are already collecting data, though the international sharing of that data will start in 2027. The good news is that CRF primarily affects centralized platforms. If you store your assets in self-custody wallets, particularly hardware wallets, you can maintain your privacy. This is one reason experts continue to stress the importance of self-custody for crypto users concerned about regulatory oversight. But CRF isn't just about collecting wallet addresses. Each account is assigned a unique identifier, which is shared with tax authorities. In practice, this means that anyone interacting with regulated crypto infrastructure, whether exchanges, on-ramps, off-ramps, or crypto-friendly banks, will have their data traced globally. The implications are significant. Mistakes in reported data, incorrect transaction details, or personal information can be nearly impossible to correct once submitted, and these errors could have consequences ranging from financial account freezes to unexpected legal troubles. Insider abuse is another concern. Employees or contractors at exchanges could potentially access sensitive user data before it's reported, creating risks of leaks or even blackmail. History has shown us that similar concerns were valid with CRS implementation in traditional finance, where unauthorized data sharing and identity theft became real problems. Perhaps the biggest worry is that governments themselves are holding this data. While the goal is tax compliance, large databases of personal financial information are attractive targets for hackers. And governments may use the data in ways beyond taxation, such as surveillance, benefits eligibility checks, or policing. So, what about avoiding KYC altogether? Even non-KYC platforms require fiat on-ramps to move money in or out, and these almost always enforce KYC. Privacy coins or mixers, while helpful, are under increasing regulatory scrutiny. Look at Tornado Cash, a mixing protocol on Ethereum. Though its technology was open source and privacy-preserving, regulators sanctioned it in 2022, alleging links to money laundering and other illicit activities. Other privacy-focused services like Samurai Wallet have faced serious legal challenges. Privacy coins like Monero, Scash, and Dash are repeatedly delisted or restricted in various jurisdictions. Decentralized exchanges are only exempt when there's no identifiable operator controlling the protocol. That said, KYC isn't inherently bad. It's designed to protect the ecosystem from money laundering, terrorist financing, and tax evasion. But CRF pushes KYC and compliance to a new level, turning crypto into a fully tracked environment. Centralized platforms are now under heavy scrutiny, privacy tools are under attack, and compliance is expanding globally. Interestingly, this may actually benefit decentralized finance, DeFi, and privacy-focused protocols. A survey last year found that 42% of crypto users plan to increase usage of privacy-enhancing tools because of CRF, and 57% expressed concern over government access to their transaction data. Demand for privacy coins, self-custody wallets, and censorship-resistant payment rails is likely to surge. Decentralized stablecoins are one example. Ethereum creator Vitalik Buterin has emphasized that privacy and censorship resistance in stablecoins are crucial for the longevity of crypto. Privacy protocols that protect transaction data could also see increased adoption, not just traditional privacy coins. Of course, there are caveats. Many users still rely on fiat ramps that are tracked under CRF. DeFi protocols can be complex for newcomers, which may slow adoption in the short term. But in the medium to long term, CRF could boost confidence in crypto. Greater regulatory clarity, combined with stronger security measures, may encourage both retail and institutional investors to participate more actively in the space. We can't ignore the dystopian angle either. CRF represents a growing trend in financial surveillance, reminiscent of digital IDs and CBDCs. As cash disappears and more financial activity becomes traceable, crypto risks becoming part of the very system it was designed to challenge, one controlled and monitored by governments. Yet history shows that pushback works. In the UK, proposed mandatory digital IDs were withdrawn after nearly 3 million people signed a petition opposing them. The takeaway is clear. While CRF benefits governments, exchanges, and surveillance companies, the individual user faces stricter KYC rules and less privacy. But there is a silver lining. Properly implemented, CRF could legitimize crypto, reduce market manipulation, and make the ecosystem safer for investors. Ultimately, CRF is a double-edged sword. It's a regulatory overreach that threatens privacy, but it also lays the groundwork for greater legitimacy, security, and confidence in crypto. The key is staying informed, using self-custody solutions, and understanding how your data is being shared. So what do you think? Are you concerned about CRF, or do you see it as a step forward for crypto's legitimacy? Share your thoughts in the comments, and if you want to learn more about market trends and privacy-focused crypto, check out our other videos right here on Web3 Verse.